On this video, I'm going to show you a chart that you should be paying attention to give you an idea of what's going to happen in the future for the economy, the recession, and your real estate investment business. What's going on? My name is Bill Allen, and I love talking about data, numbers, and help you think for yourself. I think a lot of people, they just listen to the news, they watch what's going on, and they let other people decide what's going to happen. So I built this channel around my successful real estate and business and my business building skills to help you think for yourself. So what I'm going to talk about today is a chart that I look at consistently, and I have for years. And the cool thing is when you go back at this chart, you're going to be able to see all the previous recessions. So what I'm going to do on this video today is I'm going to go back for the time that I was alive and all the things that I remember growing up as a kid and now as an adult, looking through the different recessions and ups and downs of the economy. This chart is data from the University of Michigan. So University of Michigan gets on the phone every single month and calls a bunch of people and asks them questions. So to give you an understanding, I always try to learn more about the chart before I look at it to see how meaningful is this information. So take it or leave it, but I'm going to show you how powerful this can be. In fact, Thomas Reuters used to pay $1 million a year to have access to this. And there was a point where they got access to this chart 5 minutes early, and it manipulated the stock market so bad that the SEC had to basically stop them from getting it early. So it's really powerful. This can manipulate the dollar. It can manipulate a lot of things based on the output from this chart. So I pulled this from Fred Economic Data, but it's the University of Michigan. They call at least 500 people every single month and ask them 50 questions. And I'm going to read a little bit about what they do. So the objectives of this is it's an index. So you're going to see when I go to the chart, it's an index from 100 from 1966. So Q1 of 1966, they index this, and 100 is the baseline from 1966. So you'll see there's some data points on this chart that are above 100, and there's a bunch that are below 100. The objective of this is to assess near-time consumer attitude on the business climate, personal finance, and spending, promote an understanding of and forecast change in the national economy. That's what we're looking for right now, right? What are the changes coming up in the national economy? To provide a means of incorporating empirical measures of consumer expectations. So what is the behavior and expectations of the consumer? To gauge economic expectations and probable future spending behaviors of the consumer. So that's interesting to us, right? Are they going to spend more money? How do they feel right now? And what are they thinking about doing in the future? And to judge the consumer's level of optimism or pessimism. So the consumer sentiment, how is the consumer feeling? I'm telling you right now, these feelings drive everything in our economy. Everything, especially now. We're plugged in now more than ever. We've never been this plugged in the past. And all the data and news and updates, it's affecting how we make decisions and what we do, where we spend our money, who we vote for, who we fall in love with, how we feel about ourselves, everything, right? Here's the chart. It's you can see this is the Fred data, University of Michigan, and I basically went back to 1978 or so up till 2022. And you can see here's the line right here. If you follow along with me, this is the 100. This is the baseline of the index 100, and this was Q1 of 1966. They just baselined it. That way, they can adjust the values based on how that was. So you can see it goes up and down, and there's drops and real fast dips and things like that based on what's happening. So I'm going to go through some of these. You can see in the gray, each of these gray areas are recessions. And so we're going to talk through that. And then you can decide if we're in a recession now. I know there's been a lot of talk about that. To get on the same page, I'm going to define a recession as significant, widespread, and prolonged downturn in economic activity, okay? So a lot of people will define it as two previous quarters, like 2 quarters in a row of a decrease in GDP, so the gross domestic product, what's happening in the economy, right? So even a 0.5% drop in GDP, 2 quarters in a row could signify a recession. There's a lot more that goes into that, and usually they might declare a recession, or in the case that's happening right now, say we're not in a recession, even though we are in two quarters of reduction in GDP. Usually what happens is they look back. It's like they look back and they say, yep, we were in a recession then. So how people feel during that time is very different. We're going to talk about that right now. All right, so let's look at 1980. So 1980 to 1982, there was a recession. And this recession from 1980 to 1982 was widely due to high interest rates. So the Fed increased interest rates significant, like very high, and in a very short period of time. They were combating inflation around that time. The other things that happened is the Iranian oil embargo. If you remember, during that time, there was a lot of battle going on in the Middle East over oil. So the Iranian oil embargo furthered that recession. Here's the interesting thing. Look, at 1980 to 1982, and I think this is very important to notice because something we're going to look at here in today's times, you see this drop. So this is 1980 to 1982. So you can see the drop in consumer sentiment. So I can actually grab numbers here. So here's February 1980, 67%, down to a shockingly low 51.7. And then we see it go all the way through here to 1982. So really it went this long from 1980 to 1982, and then you can see it kind of spike back up to 100 after that, right? Here's an interesting stat that I found when I was researching this. The unemployment rate in November and December of 1982, so it's right around here, right? So the Fed raises interest rates to try to fight inflation, combat inflation. The unemployment rate rose to 10.8% at the end of 1982. Yeah, we tried to combat inflation, and then unemployment just spiked to 10.8%, which is really high. And it stayed at 10% for a long period of time. So what happens is, I'm going to talk about it now, I believe that the Fed right now is raising interest rates. They are trying to combat inflation. They're trying to probably adjust the mortgage rates for housing pricing and things like that, hopefully try to make things more affordable. But in my opinion, what they're really doing right now is they're really trying to put people out of jobs. They're trying to hurt businesses, trying to put the squeeze on, which is what happens, and increase unemployment. We have a very low unemployment rate right now, and I think that's what you're going to see. Like my prediction, and I'll go on record right now saying my prediction is long term, we're going to see high unemployment rates, and they're going to start hurting businesses and start pushing people out of jobs. So that's what happened in 1982. So do you recognize any of this stuff? High inflation, Fed raises rates, right, to try to tamper inflation, and then 2 years later, after all this happens, like down the road, we see a massive spike in unemployment that lasts for a very long period of time. So think about that. And I think those are very similar factors and indicators for what's happening right now. So that was 1980 to 1982. And then let's fast forward to 1990 to 1991. So you can see what happens is it spikes back up and kind of just stays steady. You see some ups and downs, and there's some little things that are probably happening here to adjust consumer sentiment. And just remember, this is how consumers are feeling. How do they feel? And so there's a lot of information you can get from talking to 500 people on the phone all over the country. It's a minimum of 500. So then 1990 to 1991, we see the 1989 savings and loan crisis. So there was a savings and loan crisis in 1989. The other things that happened right there were more oil wars, right? We had high interest rates again. Oh, the other thing I didn't mention between 1980 and 1982 was interest rates went up, but so did housing prices. It's very interesting. What I'd like to do is I'd like to overlay housing prices on top of this. I'm trying to figure out how to do that next so you guys can see. So 1990, 1981, we had high interest rates still. We had the savings and loan crisis. And then we also had Iraq invaded Kuwait. So if you remember right now, this is the beginning of our Gulf War and all of the things that happened throughout the 90s for the war on oil. So those are a lot of things that were happening between 1990 and 1991. So you can see massive drop in consumer sentiment, kind of goes back up and just kind of like coasts and slowly increases with the heartbeat basically of the ups and downs rhythm of just how consumers are feeling. So that was the next one. Then after that, we had 2001, which I think most of you remember probably if you're anywhere near my age or close to it. We had the dot-com bubble. So Y2K was coming up in 1999 to 2000. Everybody was worried. Companies were buying software like crazy to combat this Y2K problem. The value of internet businesses were insanely high, and we had the dot-com bubble that bursts and went into recession and dropped consumer sentiment. Although you can see it didn't drop that far, but we did go into recession. A lot of companies went out of business. It was also a huge opportunity for other companies. That's what you see in a recession. That's what you should be thinking about now in your real estate business. Where is the opportunity in all of this, right? Okay, so 2001. The other thing that we had in, you can see right here, here we go, September 2001. September 2001, we got 81%, a huge drop. due to September 11th, 2001. So we saw that happen and a massive drop. Okay, then we had 2008 to 2009. I think we know what happened there. It was the Great Recession, the subprime mortgage crisis into the Great Recession, and we saw a significant drop. A lot of people out of jobs, a lot of people losing their house, foreclosure, all kinds of stuff like that. And we saw two to 3 years in housing. If you're in real estate then, and you probably were, or you are familiar with it or know what happened, we saw a significant drop in prices of homes, right? So very different than what we saw in the 80s with interest rates significantly rising and spiking. You could not get a loan during this time. A lot of stuff was cash. A lot of people didn't have cash because everything was tied up in equity in their homes, and they lost homes, got foreclosed on, all of those things. So now, after that, we went into the next one, which was 2020. So this was declared the worst recession since the Great Depression in 2020, okay, when COVID hit. So we saw right here, March 2020. We've got February 2020 going into April 2020. And huge problem, massive unemployment. I got the numbers right here. 14.7% unemployment. So if you go back to 1980, massive unemployment problem, 10.8, but we were at 14.7 during this time. Lasted a couple months of unemployment. People started getting back. I guess my question is, how did you feel during that time? Depending on what was happening in your life, but most real estate investors, we saw this pause, but like we didn't really, I can't say I really felt it. Like we all had to shelter in place and all these things, but I didn't feel the worst depression since the Great Depression. Did you? And so that's the question, like the depth of recession, the massive things that are happening here are affecting people differently, right? So the 2008, 2009 crisis, I was talking to some people the other day who had no holdings in real estate, weren't interested in real estate, didn't really care. It didn't really affect them that much, they said. And other people lost everything, right? And in the 1980s, if you didn't lose your job and you had a house and all these things were happening, like your housing prices are increasing, you already have your mortgage, you don't really care what's happening. It might not have affected you. So it's interesting to see that. So if you look at this consumer sentiment, so it dropped and it started climbing back up, right? We started coming out of this 2001. And what's interesting for me to see is all this uncertainty, all this drop from 2001 to now in June 2020. So here's May 2020, 58.4. Right around here, April 2022, 65. May, 58. June, 50. So we've seen a 15 point drop in this index in 2 months. I know that there's uncertainty out there. I know that people are feeling uneasy right now. And there's recession talk, right? The past 2 quarters have been a negative GDP, right? So a lot of people are arguing, are we in a recession? Are we not in a recession? Well, I can tell you based on this chart and based on the past, we have been in a recession, probably what it looks like if you just look back to all these other drops, all these differences, all these other gray areas. We haven't really come out from 2020 based on consumer sentiment. This area right here goes back to kind of normalized, but there are a lot of people hurting and have been. So really, if you look at this, we've been in a significant drop since about August 2021 in consumer sentiment. And this is how I'm voting with my dollars, this is how I'm feeling, this is what the masses are seeing, theoretically, with their 50 questions, right? So, massively valuable chart, and what I would say is a big thing that I can give you right now is if you keep an eye on this, it's a month behind. It's always a month behind. They always report late. They get the information, they crunch it, and then it's a month late. What you see is this is going to affect us going forward. So I would say we talk about the number of houses that go on market, number of price reductions, all these things, the GDP reduction. The news drives this. We are plugged in so tight. You can see what happens. These scarcity tactics, these issues that are coming up, all the headlines, all the fear-mongering that's happening is going to control the consumer sentiment. And what we care about is how do the consumers feel? Are they spending their money? Are they not spending their money? Because that affects our businesses. That affects real estate. That affects how people feel. And honestly, if you are in the distressed market, this is actually probably a good thing. You're going to be buying more houses than ever. Now, the downside is the demand on the back end. Supply is going to rise. You're going to be able to get discounts. You're going to be able to buy easier, better deals, deeper discounts. But on the demand side, the consumer might not be buying as many flips. They might not be, with the rates increase in their mortgages, they're not going to be able to qualify for that much money, right, on their loans. So you've got to figure out what to look at, how to adjust, and how to use this information for your benefit. So I hope this is helpful for you guys today. I know it is extremely helpful chart for me. I look at it all the time, and I encourage you to as well. You can just Google University of Michigan Consumer Sentiment Report. You can find it. You can look on this Fred Economic Data website. You can find it in lots of other places. But if the Wall Street tycoons are using it and other big real estate companies are using it, so should you. And I wanted to point it out to you. I hope it's helpful. I would love to go deeper into this, and we are going to do that at our event called Flip Hacking Live. We do it every year. It's open to the public. There's going to be a link in the description. Just click on that, grab a ticket, come join us. We're going to talk about the state of the market and all things real estate, what's happening, and we're going to give you the tools and strategies so that you can thrive in a depression, in an economic uncertain climate like we have right now. We're going to show you how to do it and how we're doing it, exactly what we're doing to help you guys. I'd love to see you there. It's an amazing event. I'll see you on the next video. And don't forget to subscribe to the channel if you like what we're doing.